Theoretical framework of accounting. The theoretical framework of accounting refers to the set of basic principles, concepts, assumptions, and standards that guide the preparation and presentation of financial statements. It provides the foundation for accounting practices and helps accountants record and report financial transactions in a systematic manner. The framework ensures that accounting information is reliable, consistent, and comparable for all users such as investors, managers, creditors, and government authorities. Accounting theory explains why certain accounting methods and procedures are followed. It acts as a guideline for solving accounting problems and developing new accounting standards. Meaning of accounting. Accounting is the systematic process of recording, classifying, summarizing, and interpreting financial transactions of a business organization. It helps in determining the financial position and performance of a business. According to the American Institute of Certified Public Accountants (AICPA), accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are financial in character and interpreting the results thereof. Scope of accounting. The scope of accounting. The scope of accounting. The scope of accounting refers to the various areas and activities covered under accounting. It is very wide and includes several branches. Financial accounting. Financial accounting deals with the recording and reporting of financial transactions of a business. It helps in preparing financial statements such as profit and loss account and balance sheet. Cost accounting. Cost accounting focuses on determining the cost of production and controlling expenses. It helps management in improving efficiency and reducing costs. Management accounting. Management accounting provides financial information to managers to help them in planning, controlling, and decision-making. Auditing. Auditing involves the examination and verification of accounting records to ensure that financial statements are correct and reliable. Tax accounting. Tax accounting deals with the calculation and payment of taxes according to government laws. Accounting information system. Modern accounting uses computerized systems and software to record and process financial data quickly and accurately. Conclusion. Accounting plays a vital role in every business organization. The theoretical framework of accounting provides the basic principles and concepts that guide accounting practices. The scope of accounting is very wide, covering financial accounting, cost accounting, management accounting, auditing, and taxation. Therefore, accounting is essential for measuring financial performance and supporting business decisions. Important accounting terminologies. Business transaction. A business transaction is an economic activity that involves the exchange of money or money's worth between two parties. Example: purchase of goods, payment of salary, and sale of goods. Capital. Capital is the amount of money invested by the owner in the business to start or run the business. Example: if the owner invests 100,000 rupees in the business, it is called capital. Drawings. Drawings refer to the money or goods withdrawn by the owner from the business for personal use. Example: if the owner takes 5,000 rupees from the business for personal expenses. Assets. Assets are the properties or resources owned by the business that have monetary value. Examples: cash, furniture, building, machinery, and stock. Liabilities. Liabilities are the amounts that the business owes to outsiders. Examples: loans, creditors, and outstanding expenses. Goods. Goods are the products that a business purchases or produces for sale. Example: if a shop buys clothes for selling, those clothes are goods. Purchases. Purchases refer to the goods bought by a business for the purpose of resale. Example: a shopkeeper buying goods from a wholesaler. Sales. Sales refer to the goods sold by a business to customers. Sales may be cash sales or credit sales. Debtor. A debtor is a person who owes money to the business for goods sold on credit. Example: if goods are sold on credit to Ramesh, he becomes a debtor. Creditor. A creditor is a person to whom the business owes money for goods purchased on credit. Example. If goods are purchased on credit from Suresh, he becomes a creditor. Revenue. Revenue is the income earned from the normal business activities. Example. Income from sales of goods or services. Expenses. Expenses are the costs incurred in running the business to earn revenue. Examples. Salary, rent, electricity, and transportation. Profit. Profit is the excess of revenue over expenses. Profit equals revenue, expenses. Loss. Loss occurs when expenses are greater than revenue. Loss equals expenses, revenue. Stock. Stock refers to the goods that remain unsold at the end of the accounting period. Conclusion. Accounting terminology forms the basic language of accounting. Understanding these terms helps in recording transactions correctly and preparing financial statements effectively. Therefore, knowledge of accounting terminology is essential for students, accountants, and business people. Uses and users of accounting. Uses of accounting. The uses of accounting refer to the benefits and purposes for which accounting information is used. Maintaining systematic records. Accounting helps in keeping a systematic and permanent record of all financial transactions of a business. This makes it easy to refer to past records whenever necessary. Determining profit or loss. Accounting helps in finding out whether a business is earning profit or suffering loss during a particular accounting period by preparing the profit and loss account. Showing financial position. Accounting shows the financial position of the business through the balance sheet. It shows the assets, liabilities, and capital of the business. Assisting in decision-making. Accounting provides useful financial information which helps managers and owners in making important business decisions. Evidence in legal matters. Accounting records act as legal evidence in case of disputes or court cases. Facilitating tax calculation. Accounting helps in calculating and paying taxes correctly according to government laws. Helping in business planning. Accounting information helps management in planning future activities and controlling expenses. Users of accounting. The users of accounting are the individuals or groups who use accounting information for their decision-making. Users are generally divided into two categories: internal users and external users. Internal users. Owner. The owner uses accounting information to know the profitability and financial position of the business. Management. Managers use accounting information for planning, controlling, and making business decisions. Employees. Employees use accounting information to know the financial stability of the company, which affects salaries, bonuses, and job security. External users. Investors. Investors use accounting information to decide whether to invest money in the business or not. Creditors and suppliers. Creditors use accounting information to determine whether the business is able to repay its debts. Government. The government uses accounting information to assess taxes and ensure legal compliance. Banks and financial institutions. Banks use accounting information to decide whether to grant loans to a business. Customers. Customers may use accounting information to know the reliability and stability of the business. Conclusion. Accounting plays a vital role in providing financial information about a business. It helps in maintaining records, determining profit or loss, and showing the financial position of the business. The information provided by accounting is useful to many users such as owners, managers, investors, creditors, government, and employees, helping them make informed decisions. Accounting process. Steps in the accounting process. The accounting process involves the following steps. Identification of transactions. The first step in the accounting process is the identification of financial transactions. Only those transactions which involve money or money's worth are recorded in accounting. Example: purchase of goods, payment of salary, and sale of goods. Recording the transactions journal. After identifying the transactions, they are recorded in the journal. The journal is called the Book of Original Entry because transactions are first recorded here in chronological order. Each transaction is recorded using the double entry system, where one account is debited and another account is credited. Posting to ledger. The next step is posting the journal entries into the ledger. The ledger is called the principal book of accounts. In this step, all transactions related to a particular account are grouped together. Example: cash account, capital account, sales account, etc. Preparation of trial balance. After posting all transactions to the ledger, a trial balance is prepared. A trial balance is a statement that shows the balances of all ledger accounts to check the arithmetical accuracy of the books of accounts. If the total of debit balances equals the total of credit balances, the accounts are considered correct. Preparation of financial statements. After preparing the trial balance, the financial statements are prepared. These include trading account, to calculate gross profit or gross loss. Profit and loss account, to determine net profit or net loss. Balance sheet, to show the financial position of the business. Interpretation of financial results. The final step is the analysis and interpretation of financial statements. This helps the management and other users to understand the financial performance of the business and make decisions. Importance of accounting process. Helps in systematic recording of transactions. Provides accurate financial information. Helps in determining profit or loss. Shows the financial position of the business. Assists in decision-making and planning. Conclusion. The accounting process is a systematic procedure used to record and summarize financial transactions of a business. It includes several steps such as identifying transactions, recording in the journal, posting to ledger, preparing trial balance, and preparing financial statements. This process helps businesses maintain proper financial records and make informed decisions. Basis of accounting. The basis of accounting refers to the method used to record financial transactions in the books of accounts. It determines when revenues and expenses are recognized in accounting records. The two main bases of accounting are cash basis and accrual basis. Types of basis of accounting. Cash basis of accounting. Meaning. Under the cash basis of accounting, transactions are recorded only when cash is received or paid. Income is recorded when money is received, and expenses are recorded when money is actually paid. Example. If goods are sold in March but payment is received in April, the income will be recorded in April. If salary is paid in May for the work done in April, it is recorded in May. Advantages. It is simple and easy to maintain. It requires less accounting knowledge. Suitable for small businesses and individuals. Disadvantages. It does not show the true financial position of the business. Credit transactions are not properly recorded. It does not match income with related expenses. Accrual basis of accounting. Meaning. Under the accrual basis of accounting, transactions are recorded when they occur, regardless of whether cash is received or paid. Income is recorded when it is earned, and expenses are recorded when they are incurred. Example. If goods are sold in March but payment is received in April, the income is recorded in March. If salary for March is paid in April, it is recorded in March. Advantages. It shows the true financial position of the business. It records both cash and credit transactions. It follows the matching principle of accounting. Disadvantages. It is more complex than the cash basis. It requires proper accounting knowledge and records. Conclusion. The basis of accounting determines how financial transactions are recorded in the books of accounts. The cash basis is simple and suitable for small businesses, while the accrual basis is more accurate and widely used by companies because it shows the true financial position of the business. Branches of accounting. Branches of accounting. Financial accounting. Financial accounting is the branch of accounting that deals with the recording and reporting of financial transactions of a business organization. It involves maintaining systematic records of transactions and preparing financial statements such as trading account, profit and loss account, and balance sheet. The main objective of financial accounting is to determine the profit or loss of the business and show its financial position at the end of an accounting period. Features. Based on historical data. Follows accounting principles and standards. Information is mainly used by external users such as investors and creditors. Cost accounting. Cost accounting is the branch of accounting that deals with ascertaining and controlling the cost of products or services. It helps in calculating the cost of production and identifying ways to reduce unnecessary expenses. Cost accounting is mainly used in manufacturing industries to determine the cost per unit of production. Objectives. To determine the cost of products. To control and reduce costs. To increase efficiency and profitability. Management accounting. Management accounting is concerned with the analysis and interpretation of accounting information for managerial decision-making. It provides financial and statistical information to managers to help them in planning, controlling, and evaluating business activities. Management accounting uses information from financial and cost accounting to support management decisions. Importance. Helps in planning business operations. Assists in decision-making. Helps in controlling business activities. Tax accounting. Tax accounting deals with the preparation of tax returns and calculation of taxes according to government laws and regulations. It ensures that the business pays the correct amount of tax and complies with tax rules. This branch is important for both individuals and business organizations. Auditing. Auditing is the process of examining and verifying the accounting records and financial statements of a business. It ensures that the accounts are accurate and free from errors and fraud. Auditing increases the credibility and reliability of financial statements. Social responsibility accounting. Social responsibility accounting is a branch that deals with measuring and reporting the social and environmental effects of business activities. It focuses on the responsibility of businesses toward society and the environment. Examples include pollution control, employee welfare programs, community development activities. Conclusion. Accounting has developed into several branches such as financial accounting, cost accounting, management accounting, tax accounting, auditing, and social responsibility accounting. Each branch serves a specific purpose and provides useful information for different users. Together, these branches help businesses maintain proper financial records, control costs, follow legal requirements, and make effective decisions. Accounting principles. Accounting principles are the basic rules and guidelines that accountants follow while recording and preparing financial statements. These principles ensure that accounting information is consistent, reliable, and comparable. They help businesses maintain proper records and present financial information in a clear and accurate manner. Accounting principles form the foundation of the accounting system and guide accountants in dealing with financial transactions. Important accounting principles. Business entity principle. According to this principle, the business and the owner are treated as two separate entities. The transactions of the business are recorded separately from the personal transactions of the owner. Example. If the owner withdraws money from the business for personal use, it is recorded as drawings. Money measurement principle. This principle states that only those transactions which can be expressed in terms of money are recorded in accounting. Example. Purchase of goods for 10,000 rupees is recorded, but the efficiency of workers cannot be recorded because it cannot be measured in money. Going concern principle. According to this principle, it is assumed that the business will continue to operate for a long period of time and will not be closed in the near future. This assumption helps in preparing financial statements. Accounting period principle. The life of a business is divided into specific time periods, usually 1 year, for the purpose of preparing financial statements and determining profit or loss. This period is called the accounting year. Cost principle. According to this principle, assets are recorded at their original cost or purchase price in the books of accounts. Example. If a machine is purchased for 50,000 rupees, it will be recorded at the same cost even if its market value changes later. Dual aspect principle. This principle states that every transaction has two aspects, debit and credit. One account is debited and another account is credited. This principle forms the basis of the double entry system of accounting. Example. If goods are purchased for cash, purchases account is debited and cash account is credited. Matching principle. According to this principle, expenses should be matched with the revenues of the same accounting period to determine the correct profit or loss. Example. Expenses related to sales must be recorded in the same period as the sales. Consistency principle. This principle states that the same accounting methods should be used every year so that financial statements can be compared easily. Example. If a company uses the straight line method for depreciation, it should continue using the same method in future years. Conclusion. Accounting principles are the basic rules that guide the preparation and presentation of financial statements. They ensure accuracy, consistency, and reliability in accounting records. By following these principles, businesses can present true and fair financial information to users such as investors, creditors, and management. Accounting concepts and conventions. Accounting concepts and conventions are the basic assumptions, principles, and guidelines used in accounting while recording and preparing financial statements. They help accountants maintain uniformity, accuracy, and reliability in accounting records. Accounting concepts are the fundamental ideas or assumptions on which accounting is based, while accounting conventions are the customs or practices followed in accounting to solve practical problems. Business entity concept. According to this concept, the business and the owner are treated as separate entities. The financial transactions of the business are recorded separately from the personal transactions of the owner. Example. If the owner withdraws money for personal use, it is recorded as drawings. Money measurement concept. This concept states that only those transactions which can be expressed in terms of money are recorded in accounting. Example. Purchase of machinery for 50,000 rupees is recorded, but the skill of employees is not recorded because it cannot be measured in money. Going concern concept. According to this concept, it is assumed that the business will continue its operations for a long period of time and will not be closed in the near future. Because of this assumption, assets are recorded at cost price and not at liquidation value. Accounting period concept. The life of a business is divided into specific time periods, usually 1 year, to determine profit or loss. Example. Financial statements are usually prepared at the end of each financial year. Dual aspect concept. This concept states that every transaction has two aspects, debit and credit. Example. If goods are purchased for cash, the purchases account is debited and the cash account is credited. Cost concept. According to this concept, assets are recorded at their original purchase price and not at their market value. Example. If land is purchased for 100,000 rupees, it will be recorded at the same cost in the books. Matching concept. This concept states that expenses should be matched with the revenues of the same accounting period to find the correct profit or loss. Example. Salary paid to employees during the year should be matched with the income earned in the same year. Accounting conventions. Accounting conventions are traditional practices or customs followed by accountants while preparing financial statements. Convention of conservatism. According to this convention, anticipated losses should be recorded but anticipated profits should not be recorded. Example. Provision for doubtful debts is created to cover possible losses. Convention of consistency. This convention states that the same accounting methods should be followed every year to make financial statements comparable. Example: if a company uses the straight-line method for depreciation, it should continue using the same method. Convention of full disclosure. According to this convention, all important financial information must be disclosed in financial statements. This helps users understand the financial position of the business clearly. Convention of materiality. This convention states that only important information that affects decision-making should be disclosed in financial statements. Small and insignificant items may be ignored. Conclusion. Accounting concepts and conventions form the foundation of accounting practices. Concepts provide the basic assumptions, while conventions provide practical guidelines for preparing financial statements. Together, they ensure that accounting information is reliable, consistent, and useful for decision-making. Accounting standards and Indian accounting standards. Introduction. Accounting standards are the rules, principles, and guidelines used for recording financial transactions and preparing financial statements. They ensure that accounting information is uniform, reliable, and comparable. In India, accounting standards are developed and issued by the Institute of Chartered Accountants of India (ICAI) to maintain uniformity in accounting practices. Meaning of accounting standards. Accounting standards are official guidelines that accountants must follow while preparing financial statements. These standards help businesses present financial information in a clear, consistent, and transparent manner. Accounting standards ensure that the financial statements show a true and fair view of the financial position of the business. Objectives of accounting standards. Uniformity in accounting. To ensure that all companies follow the same accounting practices. Reliability of financial statements. To make financial reports accurate and trustworthy. Comparability. To allow comparison between financial statements of different companies. Transparency. To provide clear and complete financial information to users. Protection of stakeholders. To protect the interests of investors, creditors, and other users. Indian Accounting Standards (IND AS). Meaning. Indian Accounting Standards (INDAS) are the accounting standards adopted in India and aligned with international accounting standards. They are used for preparing financial statements of companies in India. INDAS are issued by the Ministry of Corporate Affairs (MCA) based on the recommendations of the Institute of Chartered Accountants of India (ICAI). These standards are largely based on the International Financial Reporting Standards (IFRS) used globally. Objectives of Indian accounting standards. To bring Indian accounting practices closer to international standards. To improve the quality and transparency of financial reporting. To increase investor confidence in Indian companies. To make financial statements comparable at the global level. Some important Indian accounting standards include INDAS 1 Presentation of financial statements. INDAS 2 Inventories. INDAS 7 Statement of cash flows. INDAS 16 Property, plant and equipment. INDAS 18 Revenue. These standards guide accountants in recording, measuring, and presenting financial information correctly. Conclusion. Accounting standards help in maintaining uniform and reliable financial reporting. Indian accounting standards (INDAS) are developed to align Indian accounting practices with international standards. They improve the quality, transparency, and comparability of financial statements, making them useful for investors and other stakeholders.